So going back to this, so companies with a 7 to 10 PE ratio are financially successful companies. A 15 to 25 PE ratio are rapidly growing companies, and 40 to 50 are speculative companies. So the lower the PE ratio, they pay higher dividends and have less stock or less risk, lower prices and slow growth, whereas high PE ratio indicate the firm is expected to grow a lot in the future. Lastly, beta. Beta is a measure of stock's validity compared to the overall changes in the stock market. So what does validity mean? And that means risk. So if a stock has a beta of positive 1.5 and the market went up 10%, the value of stock is expected to rise 15%. Average beta is between 0.5 and 2. Information can be found doing an internet search for stock ticker symbol plus beta. A higher beta indicates more risk because the stock price change will be more drastic. So how do you read stock quotes? So when you have stocks, or even if you look online, you need to be able to read a stock quote and know what everything actually stands for. So starting with the first box there, the YTD, this is your year-to-date percentage change. Year-to-date percentage change is the stock price percent change from January 1st of the current year. If a stock was $43 on January 1st and $36 on July 30th, that means that there was a change of negative 16.3%. The next one is the 52-week high and low. 52-week high and low shows the highest and lowest prices the stock was sold per share during the last 52 weeks. So 52 weeks is a year, so we know $43 was the highest, $36 was the lowest. The next one would be your stock name, so your ticker symbol. This would be each company has a abbreviated trading name because some companies' names are way too long to put them on the stock market, so they give them an abbreviated name or symbol, and that's where that stock abbreviated name looks like. So Google's can be either GOOG, or there is actually another one for Google. The next one is dividends per share, DIV. Dividends per share is the total cash paid to common stockholders per share annually. It's helpful when determining the type of stock. If a company paid $10,000 in dividends for 30,000 shares, the dividends per share would be about 33 cents. Next one is dividend yield percentage. Dividend yield percentage is the dividend expressed as a percentage of the price of the share. If a company has paid $1.25 in dividends for a stock with a market price of $50, the dividend yield percentage would be 2.5%. So you would take the $1.25 divided by 50. This is helpful to know how much income to expect. A company paying high dividends is not reinvesting money to grow. The PE ratio, again, the PE ratio is the closing price of the share compared to the annual earnings per share. If a stock market price is $50 and earnings per share is 2.25, the PE ratio would be 22.2. Every dollar the company earns, the stock market price is worth $22. A high price and a high number indicates people are optimistic about the company and the health of the market. So that means they're actually buying. The next one is volume. Volume 100 is the number of transactions to the share on the reported day. It's represented in hundreds. Take that number and add 2 zeros. High and low are the high and low entries represent the high and low selling price of one share of the previous day. So if this was for today, we would look at it like yesterday, the highest price was 40, the lowest price was 37. So right there, you can see that stock prices change so much. Close is the price of the last share sold for the day. So yesterday, the last share, if we were looking at this as if it was today, would have been $42. Lastly is net change, and this is the difference between the closing price of the same share from the prior day to the current day. So how well the stock market is doing overall. There's three basic indicators. The first one is the Dow Jones Industrial Average. And so you hear Dow. This lists the 30 leading industrial blue chip stocks. The Standard & Poor 500 Composite Index covers market activity for 500 stocks. It's more accurate than the Dow because it evaluates a greater variety of stock. And then lastly, we have the National Association of Security Dealers Automated Quotations. This would be the NASDAQ. It monitors fast-moving technology companies. Speculative stocks showed dramatic up and downs. So when there's up and downs, we use two terms to describe the market. First is a bull market, and the bull market means that the market is doing well because investors are optimistic about the economy and are purchasing stock. The bear market means the market is doing poorly. Investors are purchasing stock or selling stock that's already owned. So bull, good, bear, bad. So how do you purchase stock? You purchase stock through a broker, and a broker is a person who has a license to buy and sell stock. They provide investment advice, collected commission on each purchase of sale. Purchases stock on an organized exchange, the stock market. Over 3/4 of all stock are bought and sold on an organized exchange. Organized exchanges, minimum requirements for a stock to ensure all reputable companies are used. Each exchange has a limited number of seats available, which brokerage firms purchase to give them the legal rights to buy and sell stocks on the exchange. So we have several exchanges. The first one is the New York Stock Exchange. It's the oldest and largest. It began in 1792. There's 1,366 seats available. There's 2,800 companies. Average stock price is about $33, but there are strict requirements to get in. The next one is the American Stock Exchange. It began in 1849. It's the second largest exchange. Its requirements are not as strict as the New York Stock Exchange. So like younger, smaller companies can list. Average stock price is about $24. Regional stock exchanges, stocks are traded to investors living in specific geographic areas. So there are stock exchanges for smaller regions. So these kind of include Boston, Cincinnati, Philadelphia, and Spokane. The NASDAQ is a National Association of Securities Dealers and Automated Quotations. Stocks are traded in an over-the-counter electronic market. There's 4,000 small companies. Company requirements are not as strict. They're more volatile, again, more risky, because companies are young and new. Average stock price is $11. So all of this comes back to supply and demand. The stock market is organized based upon the laws of supply and demand. So supply is the relationship of prices to quantities of a good or service sellers are willing to offer for sale at any given point in time. Demand is the relationship of prices to the quantities of the corresponding quantities of a good or service buyers are willing to purchase at any given point in time. So when we talk about supply, suppliers are going to offer less at lower prices and more at higher prices. When it comes to demand, consumers, people who are buying, are going to buy more at lower prices and less at higher prices. And that's the end.